Ever wondered how the wealthiest people manage to pay so little in taxes? It's a controversial topic, but it's not all about loopholes or breaking the law. Today, we're diving into the top 5 ways the rich legally minimize their taxes. Stick around to learn these fascinating strategies that keep more of their money in their pockets. The key to understanding these strategies lies in knowing how tax laws work and how the wealthy use assets, deductions, and investments to their advantage. So, let's get into it. 1. Real estate investments. One of the biggest ways the rich avoid high taxes is through real estate. Owning property gives wealthy individuals a range of tax breaks, including deductions for mortgage interest, property taxes, and depreciation. Even though real estate often increases in value over time, tax laws allow investors to deduct a portion of the property's value each year as if it were depreciating. This paper loss can offset a big part of their taxable income, even if the property itself is appreciating. Another powerful tool is the 1031 exchange, which lets property owners sell a real estate asset and reinvest the proceeds into another property without paying capital gains taxes on the sale. This way, they defer taxes indefinitely while building wealth through real estate. Real estate is a solid, appreciating asset that not only provides passive income, but also a way to keep taxes low. This is why so many of the wealthy invest in property. 2. Capital gains and dividends. Instead of receiving a traditional salary, many wealthy people structure their income to come from capital gains and dividends. Why? Because these are taxed at a lower rate than regular income. When assets like stocks or real estate are held for more than a year, they're taxed at the long-term capital gains rate, which is lower than the standard income tax rate. For the highest earners, this means a tax rate of around 20% instead of 37% on income. Dividends from stocks are also taxed at a lower rate if they meet certain qualifications. By earning income through dividends and long-term capital gains, the wealthy reduce their taxable income significantly compared to those who earn a paycheck. The rich prefer investments that produce capital gains and dividends because it offers tax savings while letting their money work for them. By structuring income around capital gains, the tax rate they pay is much lower. 3. Offshore accounts and tax havens. For the ultra-wealthy, moving assets to tax-friendly jurisdictions is another way to minimize tax obligations. Offshore accounts allow them to benefit from the lower tax rates in countries like Switzerland, the Cayman Islands, and Singapore. Using offshore accounts is legal as long as they comply with tax reporting requirements. These accounts provide tax benefits and asset protection, but the key advantage is in deferring or reducing taxes on foreign earnings. By setting up corporations or trusts in these regions, the wealthy can legally move profits offshore, sometimes paying little to no tax on these assets. While offshore accounts are complex, they offer a way to shield income from high taxes. And for those with significant wealth, the savings can be substantial. 4. Tax-deferred retirement accounts. Retirement accounts are a classic tax-saving strategy, but the wealthy take full advantage of tax-deferred options to shelter income from taxes. These accounts allow individuals to defer taxes on the money they contribute, only paying taxes when they withdraw funds in retirement. High earners can contribute the maximum allowed to reduce their taxable income significantly. For those who earn too much to qualify for a Roth IRA, there's a loophole called the backdoor Roth. By contributing to a traditional IRA and converting it to a Roth IRA, the wealthy can bypass income limits and grow their investments tax-free. By maximizing contributions to retirement accounts, the rich can defer taxes on a significant amount of income while their wealth grows over time. 5. Philanthropy and charitable donations. Charitable giving is a popular way for the wealthy to lower their tax burdens while giving back to society. By donating to qualifying charities, they can deduct the donation from their taxable income. Donations of cash, stock, or even property can all be tax-deductible, allowing high earners to give strategically. Donor-advised funds, DAFs, are a more advanced tool for philanthropy. The wealthy can contribute assets to a DAF, receive an immediate tax deduction, and decide which charities to support over time. This allows them to manage their taxable income and charitable donations in a tax-efficient way. Charitable donations provide a tax break and offer a way to create a legacy or support causes that align with their values, making this a popular choice among the ultra-wealthy. And there you have it, the top 5 ways the rich legally reduce their taxes. From real estate and capital gains to charitable donations, these strategies show how wealth is protected through strategic planning. Now, while not everyone has access to these techniques, understanding them gives insight into how tax laws are structured. If you enjoyed this breakdown, make sure to like, subscribe, and hit the notification bell for more insights into money, investing, and personal finance. Let us know in the comments. Which tax strategy surprised you the most? Thanks for watching.